Welcome back to another episode of FPO and G, Financial Planning for Oil and Gas Professionals. Justin, this week we are going to continue the case study series we did last week of the oil and gas entrepreneur, right? Working for a small privately held company. Either you participated in the deal or you own stock in privately held business that is being sold. And we're going to kind of move up the life cycle for this company. We're assuming it's the same company. Last time we talked about the 35-year-old who netted $2 to $4 million, let's say. Let's move the age and the amount up. We'll say, 45-year-old with, 4 to 6.
I like it. Yeah, let's just go with 6 million, give or take a couple million. And Jared, I think that's an important call out. These case studies, we could probably do 12 of them with different ages, different amounts, and so adjust them to whatever makes the most sense for you. But just like we talked about last time, it is amazing how much M&A activity has happened. We did like 60 seconds worth of searches and just pulled. Obviously, Momentum Midstream has been in the news recently as they're on the cusp of a potential sale. I think that was in Bloomberg just a month or two ago. And ARM Energy, we also talked about that headline from the fall with their giant pipeline deal. And that's just one deal inside the company. They're not selling. And then, I think, we're again recording this in Fort Worth. So obviously double legal feels like they just have the world's biggest sale every few years. So there's just countless examples of these. And we've talked about this in the past too, that you can go in a career path that leads you to a super major. You can work there for 40 years and that could be an incredible deal. You can build an incredible life and an incredible financial situation. But we want to do some case studies on what if you're in oil and gas and you have an equity stake in your company or in a specific project that they're doing, and you might have a big cash liquidation event of sorts. And so we said we're going to do 3 case studies. First one was you're in your 30s and maybe you have a couple of kids and you have a $2 to $4 million exit event. And then the case study for today is, maybe you're in your 40s and the number's more like 6 million. And then we want to do a third case study that maybe you're either a founder of the company or you have a large enough stake for this to be a 8 or 9 figure event or more. And so where should we start with this one? The middle case study, you're 45, it's a $6 million exit event.
Yeah, I would just say, mileage may vary, right? M&A activity, there's so many different ways M&A can meaningfully impact you. Your company could sell off assets. You could participate in a deal. You could own stock in the company at various levels. So, if you are, let's say 65 and you have a $2 million event, you probably need to listen to the episode about the $2 million event and the one for the 65-year-old, right? Because you got to pick and choose pieces of each of those will resonate with you. Justin, I think easiest place to start, let's talk about like estate planning, right? Because like in the first one we said, hey, this is going to be really important because you have minor beneficiaries. So, the average 45-year-old, let's say they have grade school age kids, right? Their kids are still minors, and the numbers are a little bit bigger. What should this person be thinking about maybe compared to the 35-year-old?
I think still the very most important thing is figuring out what is your current estate plan. And I think insurance, there's going to be a huge difference. In the last case study, life insurance, term life insurance, and disability insurance were literally the single most important pieces of your financial plan before anything else. I don't think that's true anymore. If you are getting a potential, exit event that's $6 million or more, you're potentially self-insured, but estate planning is still critical. Whether you have kids that are in elementary school up to junior high school, you're still in a situation where you have minor children. And so what all needs to be covered with the estate plan?
Yeah, I think one of the things is it depends on the deal mechanics, but a lot of times at this level and this participation amount, based on the transaction volume and how big these deals are, if you're getting a liquidity event of this, you are a minority owner and you don't act, so because of that, I will say there's fewer mechanics, and maybe we'll talk about that in the next one, some different, who do we want to own the assets related to the entity? If I'm an employee and this is a form of my compensation versus I actually own the underlying business, right? If I own profit interest units versus I own company stock, my ability to shift that inside or outside of my estate and the potential pros and cons of that are drastically reduced. So maybe in the next case study, we'll talk about it. But, from an estate planning perspective, you can't, if the benefits you're accruing are a function of your employment income, there's not much you can do pre-transaction to have the estate plan. I think, post-transaction, I think it's all of the same things, making sure everything's structured properly, and that, you have all your documents in place and that the time horizon matches that of your kids, right? Because your kids are still minors, so you need to be thinking about that.
That's right. So it really is the basic blocking and tackling of an estate plan. If something happens to you, who do you want to raise your kids? And as we've talked about on the podcast several times, your children are going to receive assets at some point if something happens to you. And your estate plan can dictate, well, first, let's say, what if your estate plan does not exist or it doesn't dictate this? Depending on which state you live in, when your kids are 18 or 21, their assets are theirs. And so the big consideration when you have young children is if they are going to inherit some money, and if you just had a substantial liquidation event, they're going to inherit some very material assets now. You want to have a say in how old do they need to be before they have free reign over this money.
Yeah. All right, just anything else on estate planning? Again, your hands are kind of tied at this liquidation value because, again, it's not so much money that you're absolutely certain you're going to have a taxable estate to where I need to do all this stuff. And, if you're getting this amount of liquidity event, it's probably a function of employment. So there's just minimal things you could do on the front end.
And I think the only other thing I would mention, Jared, is let's say that you have another 1 or 2 million in addition to this liquidation event. So let's say your total balance sheet is 7-8 million. I think it's okay if you just have a simple will in the state of Texas. I would probably go with a revocable living trust just so that I can avoid probate. But I guess call out there, revocable living trust is really kind of the trust version of a will. Like it's not advanced, intricate estate planning. And so my message here is you still need a very basic estate plan. At what net worth number, at what asset level do you think the tide shifts and you don't just need a revocable living trust done by an online attorney, you need a much more comprehensive plan?
Yeah, I think it's kind of like a similar question to when do you need a family office? It's not necessarily an asset value, it's a function of how complex is my distribution wishes and how liquid are my underlying assets, right? Because if I'm owning minerals and interests and there's a lot of responsibility related to that and I have a lot of complexity versus just a brokerage account that gets a step up in cost basis, those are fundamentally different levels of complexity to administer, right? And the preference to which I have of, hey, we have this working interest in this well and I never want to sell it, right? So if I have a preference of, hey, I want to hold different assets for different periods of time, I would say that generally results in some complexity. But also, if you have, let's say 10 million plus, it could begin to be a good idea to set up an estate plan that is trust-based. I also think there's a third option where it's like, hey, do I set up a will? Do I set up a trust? You could set up a testamentary trust, meaning it's everything goes into the will. And then at the time of, surviving spouse's death, a trust is set up for my minor kids or this, that, and the other. So it's not necessarily this all or nothing. I have to set up a trust right now or I have to set up a will right now. I could set up a will with architecture that actually creates a trust at the time that it's needed. So I think, there's no one size fits all, but as assets creep up, as the underlying complexity of the assets creep up and your preference about the distribution plan for the assets creep up, generally all of those things increase the probability that it makes sense to do a trust-based estate plan.
Right. I love that.
Cool. Awesome. Well, let's talk about insurance, right? Because before we get to the more offensive fun stuff, we got to talk about defense. And you talk about the financial planning process as both defensive and offensive. So the last piece of defense, insurance. How should this person be thinking about insurance?
Well, you're probably getting pretty close to being self-insured from life and disability. Maybe not, though. I think that should still be evaluated. If you have kids that are under 10, let's say you have multiple kids, there's still a chance that you need to insure your future earnings. And depends on your work plans, depends on how much money you're spending every month, depends on how expensive of a house you want to buy. So that kind of ties into the next section we'll talk about, and that is, what are you allowed to buy if you have a $6 million liquidation event. But with insurance, so maybe you're self-insured, but maybe you're not. It's kind of right on the cusp. And then I think the most important thing is, hey, this type of structure, this is not going to be hitting a retirement account. It's going to be hitting your bank account or an investment account. Therefore, it is not going to have any sort of creditor protection. Your retirement accounts do carry some creditor protection. And so you want to be mindful of what's my underlying liability coverage in my home insurance policy and my auto insurance policies, and how much umbrella insurance do I need above and beyond that. So it's probably a good time to dramatically increase your umbrella insurance.
Yeah, I love all those. I think one other thing to think about is the pricing of insurance, right? So like if you are, you probably need an analysis, and it depends on to what extent you're going back to work or not. But if you are pricing out life insurance, your life insurance is going to be meaningfully more expensive than the 35-year-old we talked about in the last episode, right? So it could make sense to ladder term life insurance versus just owning it outright. So if you think about it, if a 35-year-old buys an insurance policy, a 20-year term policy, that, actuarially is very different than a 45-year-old buying a 20-year term policy, right?
Right.
And your need for life insurance may drop down sharply since you had this big injection of liquidity, and you may not, you may be at the cusp of self-insured. So what you could do is, instead of getting a 20-year policy, you could get a 10. Or if your funding need is going down over the next few years, you could have part of the insurance last the 20 years at the more expensive rate, and then part of it only lasts for another 10 years because, the longer you work, the lower the net present value of all the future spending you're going to do, and your portfolio is going to continue to accumulate. So if you are right on that cusp of, am I self-insured or not, laddering term insurance could be a great way to help manage the cost and kind of implement a strategy that matches your time horizon.
Love that. I think that's a great thought. Should we dive into what this person is allowed to buy?
Yeah, I love the allowed to buy. Makes it sound like we're the spending police.
I know.
Yes, what
And it's fun to talk about.
Right. And also there's so many caveats. But okay, this person, I guess first question before, what are they allowed to buy? Are they financially independent?
Wow. Again, they're right on the cusp. If their primary residence is under $1 million and or has a really attractive, has an attractive interest rate, and they want to stay in that primary residence, if you like the house you already have and you're not planning on upgrading it, there's a good chance that they're pretty darn close to financial independence. You have to assume they've got some other money, whether it's investment accounts or retirement accounts, on top of this exit event. What do you think?
I think it's a function of how much they have saved outside of this. Not because they actually need the portfolio to live on, but it's just indicative of lifestyle.
It's going to be indicative of what their expenses have been and what lifestyle trajectory they're on.
Right. It's interesting from like a balance sheet perspective. Pre this event, it's tough. Like, do I not save? We talked about this a little bit last episode. Do I not save anything because the liquidity event happens? I'm pretty much good. Or do I act like it doesn't exist because I have no control over when the company sells or not? Right. So there's a lot of different approaches you could take, but I think if you have been saving and have built up some amount of assets above and beyond this, probably in pretty good shape. But again, it's also a function of lifestyle only inflates one way, and there's something psychologically difficult about having $4 million hit your bank account and then going back to spending as usual and nothing to change. And I would argue that should go up.
Yes.
Right. But the point is, to what extent, how long is it sustained?
We made this call out on the previous case study, and I want to emphatically make it, with an even higher level of conviction here. If we are talking about a 68-year-old, yes, unless there is some unusual spending going on, you're absolutely financially independent. You're good to go. This is enough money. 6 or 7 million is plenty by and large, unless there's a unique spending situation. But this is a really good opportunity for us to talk about. There's a giant difference in reaching financial independence at 45 versus 65. Same principle as the prior case study. You have 20 more years to fund. So if you are going to full on retire, you cannot take 5 or 6% as a withdrawal rate. You have to assume that there's a chance that you could live 50 more years or more. And so you have to have a much lower withdrawal rate. And so that's why there's some nuance there. If you're listening to this, you might be thinking, my word, they have 6 million or more. Like, how are you not financially independent? And that's totally right if you're 65 years old. But there is a chance that, hey, if you're 44 and you have 4 kids and you're going to upgrade your home, well, in that case, you're probably not.
Right. And okay. So if I am going to live off this portfolio and all 4 of those kids are in private school, that's
where are we at now?
What's the distribution rate at that point? Right. So
like even 4% of 6 million is not remotely covering that bill. Or kind of a fun private conversation from our Slack channel earlier today. I sent a Zillow listing to our Houston team. We talk about this all the time with the Houston team. And I mean, think about our ages. We all have kids, like we're in our 30s. So all of us are doing this crazy math of like, okay, how much house do we own now? Is it our forever home? Do we want to buy another home? And where in the world are we going to send our kids to school? Is it going to be public school? Is it going to be private? And how do you kind of optimize the home purchase within the right school district or spend less on the home and send your kids to private? But Jared, I mean, I sent a Zillow listing to our Houston team, and I said with the listing, man, no shade to whoever owns this house, but this is easily the ugliest $1.9 million home I have ever seen in my life. And it was $1.9 million. And, as you can imagine, it's in Memorial High School. So it's in the best school district. It's in a great area. But that is a perfect example that, hey, if you've got a bunch of kids and you're trying to send them to a public school and you want their public junior high and high school to be really highly rated, well, the buy-in price is comically absurd.
I want to link to that Zillow link, and I hope that one of our mighty followers owns this.
I know. I'm scared. What if one of our listeners
if
owns
you're in
this
Memorial,
I think it's in Hedwig Village.
Okay.
So
if you're in
I've
Hedwig
already
Village,
given it away. I shared the price.
We will link to it.
It's not a big village. You can find it pretty easily.
Yeah, but I do think, right, you're touching on something really important. You, like all of our clients, that we have a bunch of them at a bunch of different ages, you are in peak spending years. So it's going to be really hard to have a sustainable withdrawal rate at the same time that your kids are the most mobile and dependent on you that they are. Right? So it's like, it really comes down to what do I think my estimated expenses are? But again, I think you're in a good spot, right? Again, of course you're in a good spot. You've had an unbelievable liquidity event and your net worth is in the top, 0.5% of Americans. So like it's remarkable, but we're just empathizing and saying, hey, it's not as easy as I had this event. I am financially independent. I think there's some math that needs to be done in a lifetime cash flow analysis that says, hey, what do I expect this to be? Because Justin, you alluded to it. My time horizon is 20 years greater than the 65-year-old. And all of those 20 years are higher expense and I have no pension or Social Security.
Oh my gosh.
So it's kind of like a perfect storm of of spending, right? So so you really have to kind of rein in what your spending is going to be. And then of course, still on the hook for healthcare. So I think the person might be financially independent, but I think it's very sensitive. So I think you have to have a pretty solid base of assets to supplement that. I don't think that in and of itself will get you where you need to go.
We talk all the time. The most expensive decade in life is when your kids are, say, 10 or 12, up to them being 22 or just whenever they're kind of out of college, off the payroll. Incredibly expensive time in life. And so, it is tricky to be financially independent during that time period because you're going to spend a ton of money, and it's really helpful to have some earned income that can cover that. Now, what are you allowed to buy? Cars, vacations, golf memberships, second homes, anything else that you would add into this?
Yeah, I mean, that's the thing. You could buy whatever you want, right? It's just the question is, what are you willing to do for that thing, right? We talked about that last time, there being freedom, and I know that's not helpful. You just have to decide what's important to you, right? And again, if you want a second home in Tahoe and you plan to go back to work and you get excited about going back to work, great.
That can work.
Yeah, that could probably work better than not going back to work and then upgrading the home in Houston and expecting your portfolio to just take you for the next 60 years with life expectancies moving up.
Yes. Yeah, so you have a ton of optionality if you're going back to work. I think the verbiage you use really helpful in the last case study. You can do almost anything, but you can't do everything. And I think the only change with this case study is you really can do anything, but you can't do everything. Right. And so in the first one, you can almost do anything within reason. There's some serious caps. But with this one, yeah, you really can do just about anything. But the timing and the future income is going to determine how many of those things you can do at once.
Yeah. And I would encourage you to do something. You know what I mean? The worst thing you could do is this could happen and then you just go back to business as usual, right? Money is like a tool to, and you can use it to spend it, to live a meaningful life, invest in relationships. I think it's so important that like we remember that. It's not just meant to be accumulated indefinitely.
Jared, I've got a question for you, maybe an interesting hot take. Does anything in spending even matter outside of your home, or homes, plural, if you have more than one? Real estate has gotten so insanely expensive that, like, in this case study, is it even a needle mover if you're like, well, yeah, I want to go get a car that's $100,000, which now that's like any SUV or loaded truck.
Yeah, I mean, I think it does. I think it still does matter. There's just diminishing returns in optimizing it. You know what I mean? Like if I shop at Whole Foods and then I decide to switch to Kroger, and then I get all the local or all the Kroger branded stuff. I like think about how much mind share that takes up in my head if I grocery shop once a week. That's going to save me in the $20s of dollars.
Okay, that is the perfect example of what I'm talking about. Now I want to extrapolate your grocery example. And I guess what I'm saying is if you bought a home, let's say it's in Katy or the Woodlands, and you bought it for $500,000 in 2019, and you have a mortgage with a 2 or 3% interest rate, if this is you could go buy two. I don't even know what a Porsche costs. I'm just going to say $150,000. Let's say you go buy two of them. That doesn't matter. Like, it's fine. It's like a grocery expense compared to upgrading your home to a $3 million home.
Right, exactly. So I think that is the driver.
Or buying the listing I just said was the ugliest $1.9 million home I've ever seen in my life.
Yeah. So I think that's the way to, like, what does my family need from a housing perspective is really like probably the defining factor of am I financially independent at this amount of money or not?
Yeah.
And what is but that's also predicated on what has my housing situation been up to this point?
Yes. And it's crazy that it's that extreme, but it is kind of that extreme.
Yeah. But, and again, I think all those things matter, especially if you say, hey, you might add a couple years to how long you need to work if I'm buying the $100,000 Porsche on repeat every 4 years. Right. Yeah. Like that could make a difference. But again, I do think there's something psychologically to start with the big expenses.
Yeah.
Right. Like there's so much value to be gained in understanding, hey, the vast majority of my expenses are going to come from these two line items.
Also an interesting call out here. I'm sure we have all sorts of different generations that listen to our podcast. And I know my parents and my parents' generation, they kind of, there's been this gravitation toward telling young people, what does Dave Ramsey say? Stop buying lattes. Mm-hmm. Stop going out and buying your $6 coffee. And this conversation is a great example of how I think more Gen X than millennial, or sorry, what's the youngest generation now? Gen Z, more Gen Z than millennial. So if you are in your 20s now, I think you feel this. It doesn't matter if you buy 4 lattes a day. Like, you're still not buying a home. Like, the big rock is so insanely different. The buy-in is so impossible for people that are 25 today that the conversation of, well, just quit buying lattes, quit going out to lunch. Didn't Mr. Wonderful have a clip the other week where he's talking about how young people would be able to afford more if they just made a 99-cent sandwich at home instead of buying a $25 sandwich for lunch? And well, that you can live off of 99-cent sandwiches. Is that just like Wonder Bread with nothing in between?
The good news is that'll save you a lot of money because it saves you money on the sandwich and your life expectancy. So it's more.
That's a good point.
Fewer retirement years to fund.
Yes. But doing that is not going to put you in a position to buy a house.
Right. So I think like Cliff Notes, like housing will be the single biggest determinant of what you expect that to be. Right. And like figuring that out. And again, there's no right or wrong answers. We're not prescribing.
Yes.
Right. Like it's all trade-offs.
Yes. There's not a right or wrong answer.
So how should this person actually think about allocating this money? And again, the $6 million, we should have probably clarified it sooner. It's after tax.
It's after tax. Yeah.
So you get that $6 million lands in a brokerage account. What are they doing with it?
You are getting close to being able to consider alternative investments, but I want to give a few quick disclaimers. Alternative investments are helpful when you have a significant amount of money because it gives you exposure into potentially a great asset that has returns that do not correlate with public stocks. Now, I just said it has returns that don't correlate. I did not say it has returns that are better than public stocks. I would not expect that at all. And it could turn out that way, but we're also having this conversation in a time period where the last 14 months in a diversified portfolio of global stocks has made like 40%. And so don't ever think that a really sexy private real estate deal is going to be significantly better than just the greatest publicly traded companies in the world, because you have no guarantee of that being the case, and you have plenty of time periods where it's not the case. So you're kind of at the cusp, but I think you need to skew still towards a traditional portfolio. And the reason, Jared, why does every RIA, why does every financial advisor say you shouldn't have a bunch of alts until you have 6 to 10 million in assets?
Liquidity, right? Most of them, generally speaking, are less liquid.
Right.
And higher fee. And again, lower correlation, right? The stock market has been an excellent machine to compound wealth over decades. The reason why alternatives make sense isn't because it creates a meaningfully different terminal wealth value. It just builds what we call portfolio resiliency.
Right.
Just becoming more and more like just increasing the number of ways in which I can succeed is really a good way to think about adding it. So, but again, alternatives are a lot of times something that are sold versus something that is bought, right? Somebody says, hey, you need this, and it meets a need that somebody doesn't really have. And again, if you're all taxable money, alternatives are also infamously overgeneralizing here, tax inefficient. So you got to think about that. I think we got to go back to the home purchase conversation and think about asset allocation here, right? Because here's the thing. If you retire and you say, okay, I am financially independent and I just want to modestly upgrade my home, okay, you no longer have employment income to get a mortgage. How are you going to finance that, right? And again, there's creative things you could do. You could do box spreads. You could do pledged asset lines, right? There's ways you can create income or create liquidity from your investment portfolio if you do invest it, but you need to figure out, okay, what's my down payment, right? So if a lot of that money is spoken for over the next 12 months and you don't have a funding source for a home purchase, that needs to be factored into how you're thinking about what my investment mix is, right? The worst thing you could do is say, hey, I'm going to go 100% stock because I need that rate of return to sustain my spending over the next 60 years. There's a bear market in equities to start you off, and you decide to buy $1 million home. And you got to sell all that at a loss. Sell a lot at a loss.
Yeah.
So, yeah, but I mean, I think I would skew simple, right? Like as I think about investments, one of my fundamental beliefs is, the simplest option is oftentimes the best. So you can begin to look at alternatives. I don't think you need to, but you just need a duration match portfolio, right? What spending do I have over the next 3 to 5 years, and do I have enough liquidity or sources of liquidity to fund that?
Jared, I want to ask you this question. You get $6 million in your account. Let's say you're at one of these companies and that's in your investment account now. Are you investing all $6 million lump sum at once, or are you going to dollar cost average it?
I'm going to invest it all in a lump sum because I follow the data and evidence, Justin. No, I mean, here's the thing. Like, it's one of those things where everybody's like, the market's expensive. Yeah, the market's been expensive for 5 years based on traditional valuation logic, and your money's more than doubled over that time period. The other thing is, if you're investing in a resilient portfolio, a global equity portfolio, U.S. U.S. valuations are stretched relative to historical averages, which again has no predictive power over the short term. Global equities emerging, developed much more reasonable valuations relative to their historic averages, and some alternatives, some stuff with lower correlation, right, or even maybe slightly negative correlation to equity, right. So I think if you're buying a diversified portfolio, there's no way to know. So I would do it all lump sum, and I would have a tough time with that, honestly. Like even knowing that that's the probabilistic, because here's the thing: I could wake up in a year and I'm down 30% right out the gate. That's tough.
Yep,
that's tough. But I think you can't mix process and outcome. The process is good, so we got to be married to the process and trust it. But it'd be hard. What would you do?
I would certainly skew more toward lump sum. For our listeners, we've covered this before. In basically the vast majority of rolling 5, 10, and longer time periods over the last century, lump sum investing has beat dollar cost averaging. Dollar cost averaging is kind of billed as this wonderful thing, this great thing, and it is because it follows the cadence of your life and cash flow by and large, right? So you get a paycheck every 2 weeks. You are buying into your 401k every 2 weeks, and that paycheck with your discretionary cash flow, you can invest into a brokerage account. And so the cadence of earning an income, having cash flow, lends itself to dollar cost averaging, and that is wonderful. You're buying in at all prices. But if you have the option to make a lump sum investment instead of dollar cost averaging, history would tell you should do lump sum. Now, it's not rocket science. It's literally just because the market's up more than it's down. So this is a big number. I have total understanding if someone receives $6 million in their investment account and they want to do some dollar cost averaging. I get it. And I get regret minimization that, lump sum is the textbook, most likely correct answer, but on the off chance that we're about to have a market crash right after it hits my account, I want to minimize that potential regret. And so, do you want to do something like maybe you put $3 million to work immediately and then have a set schedule that you will dollar cost average in the other $3 million? Something like that could be reasonable, even though the textbook would say lump sum.
Yeah, I agree with that. Ideally, you accelerate the dollar cost averaging plan if you get them. If there
is any, yes.
Yeah.
So you never, you must adhere to this rule. You never postpone the investment on a dollar cost average, but you can accelerate it.
I like that. Yeah, that's a good rule of thumb. I feel like I do a lot of the trading at our firm, and I need somebody to hold me accountable, because I'd be like, it just seems maybe no. It's going to go lower, right? It would just be so easy. I think that's the thing. You need to get formulaic with the process if you are going to go that route,
right?
Because it's an emotional decision to do it, and so if you don't have a plan, emotion's going to drive it, and you're going to compromise, and you're going to do the wrong thing at the wrong time.
The last 17 years have been 17 of the best years ever in the U.S. economy and stock market. And if you have just diligently watched news channels every day for the last 17 years, you would have found countless reasons to postpone the dollar cost average.
Right.
A lot of bad news that you would think, surely this is going to make stocks go lower.
Yeah.
Yet great companies still find a way.
Always. But that's the thing is, there's a behavioral issue, right? Of hey, what helps you sleep well at night, right? And again, this gets back to, what do I need to retire, right? Again, if you're doing the math and you're planning to go back to work and you hit the home run, you struck gold. I don't really want an aggressive equity allocation because I don't need it and I plan to go back to work and I'm kind of playing with house money at this point. You should not be in 100% stocks, even if you have decades till retirement, right? There's a comfort component here. We don't change the asset allocation and make it more diversified because we think it's going to be better returning. No, concentration is what yields wealth. Diversification is what risk manages it.
Right.
So Justin, this person, we talked about, hey, they're right on the cusp. Future work opportunities. Do they go back to work? Do they work somewhere similar? Do they go to, a super major? What do you think? What do they do?
Okay, I'll just speak personally. Pretend that I'm in your shoes and I get this payout. my favorite option would be this. I would either upgrade my primary residence or I would buy a vacation home and I would keep working. Assuming that, I had a great work opportunity with work that I really enjoyed doing. If that was my situation, that's absolutely what I would do.
Yeah. Yeah. I love it. I think the person that took the more entrepreneurial route, if you will, is going to have a hard time fitting in at a big box firm.
Yeah.
Right. So I think finding a work like that is helpful. I also think consulting is just such an underrated career path, right? Like how do I apply my expertise fractionally to several different employers versus just having one, right? And you kind of you determine the pace, you determine the pay. And a lot of times companies are very interested in not having to hire a full-time person, and they're happy to pay a premium to have you hourly, right? And again, maybe you scale work back, and it's not this, again, we talk about this third way a lot where it's, do I go back to work or do I not? It's like, okay, is there a way I could go back part-time as a consultant?
Yeah.
Right? So I think I would do something like that. But again, it would have to be in a firm and opportunity that's kind of values aligned, right? It's just culturally very different to go to being one of 10, one of 20, one of 30 employees to one of 30,000. So I think it's got to match your preferences as a worker bee.
Yeah. I think I'd be interested to just get data on this, on like, what is the general answer for people's ideal work situation? My hunch is that most people, if they could have some sort of autonomy over schedule and ensuring that they are doing work that they enjoy, I think most people would not retire young at all. And they would keep working well into 60s and 70s.
Right. And
I think it's really hard to get that equation of I control my schedule. I can work 4 hours this week or 34 or 54. And I have geographic independence and I enjoy it. Like those are all hard boxes to check.
Yeah. Yeah. And the tough thing, yes, you got to kind of find out what are your big rocks there in terms of future employment. And that kind of governs it probably. Cool. Awesome. And again, I think this person, right, taking, we talked about in the first case study, that person could absolutely make distributions to supplement, kind of expenses. And this person definitely is in a similar boat, right? And I think, with that amount of money, it's not irresponsible to say, hey, I need a portion of this to subsidize my lifestyle today. The thing that you need a lot of self-control over is that it doesn't supplement your lifestyle indefinitely, and then also need to produce retirement income, right? But you are in your highest spending years. So, if you need to make periodic distributions within a sustainable range, it's totally reasonable.
Yep. And I think that's a good way to think about it. If you need to take 4% of your portfolio a year, yes, history shows that in a lot of outcomes, your principal continues to compound and grow. But you have to assume, hey, what if I come up on a pretty slow growth 10, 20-year window? Well, a 4% withdrawal is not going to keep compounding. It's going to stay flat or dip, right? And so trying to keep any sort of supplemental income from this portfolio to a 2% withdrawal rate, I still love that idea. Unless, just like we mentioned, maybe you do have a very affordable home at an incredible interest rate and you can full on retire. That's a different story.
Yeah. Awesome, Justin. Well, I think this person had kind of some similarities. I think with the next one, we'll kind of probably deviate a little more than we did.
Right.
But anything you want to wrap up with this person in the case study?
I don't think so. Apologies if you own that home that I kind of dogged on. I'm sure it's a great home. It's just the price is really high.
He's hedging already.
That's right.
He's hedging already.
Yes.
I can't wait. Love to hear from listeners. Share your ugly homes with us or berate Justin for making fun of your home. Podcast at brownleewealthmanagement.com. Thanks. We'll see you next time.
This podcast is for informational purposes only. Nothing discussed during this show or episode should be viewed as investment, legal, and tax advice. If you have questions pertaining to your specific situation, please consult the appropriate qualified professional.